Hello, and I welcome you all to the second session for today. After understanding the equity markets, now it's time to move on to the debt markets. For explaining about the intricacies of the debt market, we have with us Mr. C.A. Mahendra Kumar Jajoo ji. He is the CIO with the Mirai Asset Management Fund. And to formally introduce today's faculty, I would like to invite N.K. Jain sir, who is a past colleague.
Thank you, Purvi. I am given the task to introduce second speaker of the session, who will be delivering on debt market. Debt market is bigger than equity market, and debt market also has many risks to invest. So that is where we need the expert opinion, expert advice, and understanding, so that we don't lose in the debt market and we get best out of it while mitigating the risk. For that, we have our today's speaker, CA Mahendra Kumar Jajoo. Mr. Mahendra Kumar Jajoo is the Chief Investment Officer of Fixed Income at Mirai Asset Investment Management India. He is overall responsible for supervising all debt schemes of the Mirai Asset Mutual Fund with an overall AUM of more than rupees 10,000 crores. He has over 27 years of experience in the field of financial services, including 12 years of experience in fixed income fund management. Prior to this, he held the position of Executive Director and CIO at DHFL Pramerica Asset Management, Executive Director and CIO Fixed Income at Fortis Investment Management, and Head Fixed Income at Tata Asset Management. He has also been associated with organizations like ABN AMRO Asset Management Limited and ICICI Group. He is a silver medalist of Chartered Accountants with lot more feathers on his cap. He is also a company secretary and holds CFA qualification from CFA Institute USA. With this, I request all of you to welcome with a big round of applause. I request Sri Naresh Dhoot to give a small bouquet of memento from our Devinagar Study Circle. And also Chintan Bhai, please join for one more gift and Jansa. Now I request CA Mahendra Jajoo to take. Thank you.
Good morning, everyone. Good morning. I think you had a long morning and a nice breakfast. In a room full of chartered accountants, to talk about fixed income is a little bit intimidating, because chartered accountants are experts in financial market, and all of us make so much money in the equities market. So that becomes a little bit of a dull subject. And I face this challenge all the time. I was in Ahmedabad on Friday, and we had organized a summit of the CFOs of the large corporates in Ahmedabad. And I was just telling them that, look, as CFOs, not only the promoters, but everybody in the organization, from the CEO to the peon, is looking towards us for advising in his personal investing also. So individually, we may be all very wealthy and well-to-do, but then there are so many people who look towards us for professional advice. Sometimes we charge to them, but most of the time I don't, and most of us are very helpful. So we have to know the full perspective. There's another, very interesting side of the debt markets, as I always say. There are three parts of, money management. First part is earning. So we earn money by our professional services, or different people have different occupation. You earn money, you spend money for your personal requirements, and then you save some. With that saving, you create wealth. You create wealth by investing in the right product. Most of us as chartered accountants, I'm a chartered accountant myself, have you heard, are able to multiply our money by investing in the equities market. So earning and then wealth creation. Then the third part is wealth preservation. आपने सुना होगा आदमी फकीर से राजा हो जाता है, फिर वापस फकीर हो जाते हैं, राइट? In my 30 years of experience in financial markets and looking at different people, I find that earning money is not so challenging. Creating wealth is a big challenge, but the still bigger challenge is to preserve wealth. And when it comes to preserving wealth, for the old times when you need the money most, the debt plays a very important part. So with that introduction, let me shift to the professional side of the money management or the debt side. We are now, by and large, reconciled to the fact that the interest rates are going to be higher for longer. Most of you would have invested in debt mutual funds, or your clients would have invested, and you would have seen yesterday suddenly the interest rate went up. Today is a very good day to talk about debt markets because we had the Reserve Bank monetary policy on Friday, and there was a big shift, and suddenly the interest rates went up by 15-20 basis points, etc. So even though you aware that interest rates are going to be higher for longer, etc., within that there is that volatility which is very difficult to manage. There are very subtle differences between how we look at the equities market and how we look at the debt market. There are a couple of differences. Let me tell you what happens between how to make money in equities market and how to make money in debt market. So in equities market, our job is to select the right stock. In the sense that if you think Reliance is a good company, your mental setup has to be that I am hiring Mukesh Ambani as my business manager, and then let him do his job. So my job is to identify the right stock. And let's say if you are owning a Maruti, so even as we have this conference, we are discussing debt market, equity market, and all that. Maruti factory is continuing to churn out cars every hour. Those cars is being shipped, they're being sold, and the Maruti company is making profit. So therefore, your job as an equity market investor is to identify the right sector, stock, and I think I was not here for the full duration, but I'm sure Meher would have touched upon all of that. Once you have invested, then you are faced with the challenge of dealing with Mr. Market, right? Mr. Market comes every morning and tells you, आज मारुति का price इतना है, आज उतना है. So then as a smart investor, you need to know when the price is higher than the fair value, and when the price is higher than the fair value, where it discounts all future possibilities, and then you book profit. As long as the market price does not discount the fair price of the full future potential, you keep holding, and the vice versa. Sometimes Mr. Market is very disturbed by temporary factors, like Monday, Mr. Market may be disturbed by Israel-Hamas battle or some of those things. Then you can decide, आज तो अच्छा लग रहा है, so that's why we say buy on correction. Now, what happens in the debt market, right? In debt market, you buy a 10-year bond at 7% coupon. And the same volatility is there in the equity, in the debt market also. So in equities market, if you don't do anything except select the right stock, you will maximize your profit. Is that clear? In debt market, if you don't do anything, then after 10 years, how much money you will get? 7%, right? That's why it is called fixed income. So in debt market, if you don't do anything, you will make minimum returns. And if the interest rates go up, you have to buy more or, etc. And then interest rates keep moving. The interest rate cycles are typically 2.5 to 3 years. So typically interest rates move by 2 to 2.5% in its interest rate cycle. So 6% becomes 8%, then it again becomes 6%. How does that happen? Reserve Bank will keep watching the economy, so there is excess liquidity that leads to good demand. Demand leads to higher inflation. Then RBI will tighten liquidity, they'll increase rate. It will reduce demand, it will reduce inflation. Again, RBI will cut rate. That cycle keeps happening every 2.5 to 3 years. Like there is morning, then the afternoon gets very hot, evening becomes cooler, night becomes very cool, again the next morning. So like the day and night and so many other cycles, we have the debt market cycles. In equity, if you become too active, you make no money. Most of the time you end up losing. The only trick to make money in equity is to identify good stock, hold it for longer. In debt, it is the other way around. If you don't do anything, you don't make any money. So therefore, the way you look at the two markets has to be different. The last thing before I come to my technical session is that in the previous session, and I think in the vote of thanks, it was mentioned by Jensen that there were more than 100 charts. And I was here for part of the discussion. I think it was a very intense discussion on the Indian economy and so on. So I take it as given that you are already familiar with the technical side, charts, data, everything. So I don't have to look at the data side in that much detail because you're already familiar with that. Also, there is a difference again between how the equity market has to be analyzed and how the debt market has to be analyzed. In equity market, as we said, we have to identify which is the best stock. So we have to see what is happening. What is the best option? There is a far more complicated process in identifying which is a good sector, which is a good stock, which is why, like the cricket, stock market is also like cricket. So in cricket, you have one Tendulkar or one Virat Kohli or one Dhoni, one player, two players typically in a generation who make, who make obscene amount of money. But then you go to Shivaji Park or now you go to, let's say, any sports park, that hundreds and thousands of boys were slogging it out every morning. Most of them don't even make it to the state level cricket team. Now there is IPL that has given a lot of money to sports, and therefore there are B level players, C level players who have started making decent money. So now even if you make it to Ranji Trophy for a match, you get 50,000, you make decent life earnings, 20-25 lakhs a year. So like that in equity market now, there is one Rakesh Jhunjhunwala or one Ramesh Damani. Rest of us all are only talking about one stock which makes money for us, but the 100 which are in the drawer which has lost money, we don't talk about it, right? Can you relate to what I'm saying? So in stocks now there are mutual funds where industry where I work. So an average person who doesn't understand much about the stocks also can make decent money by investing in mutual funds. So in equity markets, you have to identify what is the happening theme. In debt markets, the central banks decide what should happen to the interest rates. Is that distinction clear? In the equity market, government doesn't decide कि कौन सा स्टॉक क्या भाव पे जाएगा, किसका वैल्यूएशन कितना देना है, जोमेटो को डबल करना है कि स्विगी को आधा करना है, right? But in debt market, What do we care? What is Jerome Powell thinking? What is Shashikant Das thinking? Do we care about inflation? We care about inflation only because RBI cares about it, right? So therefore, in debt market, if you want to get the interest rate direction right, if you want to be correct about your prediction on debt market, you don't have to look at data. You don't have to look at the data as it is. That is, you have to look at how the Reserve Bank is interpreting that data. In equity market, you have to interpret your data and see whether reliance will become double or it will become half. In debt market, it will move because RBI wants to take a certain view. So therefore, in debt market, our job is to understand how RBI is thinking, because they are the people with unlimited check writing power. So if they want, they can buy bonds. If they want, they can sell bonds and so on, right? I think most of the time when we talk about the debt market, we start with the inflation, then GDP, then ऐसा होगा वैसा कुछ होता नहीं है लाइफ में. I have spent 30 years of my life in fixed income. I started my career in 1991. You know what is the significance of 1991, right? That was the year when India launched the financial sector and the industrial reforms. So as a young person, I was very privileged to have started working when Dr. Manmohan Singh started the financial sector reforms, and I have seen all it happen. And I have been lucky to have survived 30 years in markets. The challenge in the markets always is not to get the market right, etc. If you survive 5 business cycles, that's the real test. So then again, you look at difference between Virat Kohli and other players. There are players who will come and make a big century in 1 match, 2 matches. They don't last 1 season. In anything, Amitabh Bachchan for that matter, at the age of 80 is more popular than any of the younger stars. So survival is very important. So therefore, when you were attending the first session, your job was to identify which sector will do well, whether it's defense, railways, whatever. In our section, we have to focus on what the people who matter are thinking. So you have the same set of data points on which you will have a different interpretation. So last time I think in the debt market, there's so much excitement about the fact that the Indian bonds are going to be included in the JP Morgan index, right? But you see how Mir was right? So the perspective is very different. So let me come back to the final comment on this side, that debt is important for people who have wealth. People who don't have wealth. There are a lot of times when young people come to me, 25 years, 30 years, sir, how should I invest in debt market? What should I do? I said, boss, you should not be investing in debt market, because debt market is for people who have made wealth in life. तो तभी शुरू कर रहे हो. अभी you should go on the other side of the debt, which is the moment you get your first salary, borrow करके तुम्हारी जितनी औकात तो उससे 4 गुना बड़ा घर लो. So that when your salary becomes 4 times, if your salary becomes 4 times, your घर का price becomes the same, I mean higher than inflation, तो तुम हमेशा 10,000 का ही तुम्हारा salary रहेगा, right? Your technical salary will remain 10,000, because जब 10,000 आपकी तनख्वाह है तो घर का दाम 2 लाख, आपकी सैलरी 20,000 हुई, घर का दाम 4 लाख एंड सो ऑन. तो आप यदि सेव करके, लेवरेज करके, इन्वेस्ट करके वेल्थ क्रिएशन नहीं करोगे तो आप हमेशा 10,000 की सैलरी पे रहोगे, चाहे आपकी सैलरी नॉमिनली बढ़ के हो गई 5 लाख. So I tell them you should borrow. So there is other side of the debt. So these are some of the things that we need to remember. Now let us look at the interest rate markets, and as I said, the new normal for the debt markets is the higher for longer scenario. And as Mir was also saying that for us 5% inflation is normal, for them 5% inflation is a very, very scary thing. So why is the interest rate environment going to be higher for normal? And then we will put our whole presentation in the context that there is a set of data in the market, and we have to see that data in the context of how the central banks are looking at it, which is what will determine the course of interest rates. So if you look at the Federal Reserve, they have three mandates, right? They have three mandates. They have to ensure growth, they have to ensure full employment, and then they have to keep the inflation under control, right? Now let us look at what is the situation right now. There is so much talk about growth being poor. There is talk about the recession coming. There is talk about how the high interest rates will affect the interest, the growth, etc. But then if you look at the markets, actually the growth of the US economy in the last quarter, that is the June quarter, was at 2.1%. 2.1% is the average growth rate of the US economy in the last 10 years, except for the COVID period. So you can see the graph that post-COVID, there was a recovery. During COVID time, there was negative growth. So if you take out those outliers, the growth of the US GDP for the last 10 years is at an average of 2.1%, and the last quarter growth is 2.1%. So the whole discussion about the recession in the global economy, etc., is not supported by the current atmosphere. There is something called lagging indicators in our fixed income world, and there is something called leading indicators. Now, what is the difference between lagging indicators and the leading indicators? Lagging indicators are the ones which tell us what happened. So if I say that last quarter GDP was 2.1%, it's a lagging indicator. Last month inflation was 6.85%, that is lagging indicator. Leading indicator is what might happen. So if you look at PMI, or if you look at the Reserve Bank survey on inflation expectations, or if you look at the RBI's projection of the GDP growth in the Friday policy, that is the leading indicator. So there has been a very funny situation in the last 1 year that every time there is a lagging indicator, it suggests a strong growth momentum. So GDP growth, housing starts, credit pickup, everything is suggesting continued growth momentum in the US economy. Whereas you look at any leading indicator, PMI, etc., everything suggests that tomorrow the US economy will go into recession. So the point is that market's interpretation of the growth has been extremely poor. Look at this. There is something called probability of global recession. So there is an index which suggests whether the markets expect the economy to get into recession or not. Now you can see for the last so many times, right? The green line, this line is suggesting that this is market has no expectation either recession or something, right? Now you see post the recovery in the COVID, market has been expecting a recession. This line below 50 means market is expecting a recession. Sorry, growth. And this is market is expecting recession. So just during the COVID time, market became very disappointed. So they said probability of recession is very high. Now you see after the interest rate started getting increased, market had a very high probability of recession. But now last 2 months, market is now reducing the probability of recession. So market is beginning to accept its mistake about the projections of the global economy. So now the probability of recession as indicated by market is coming down. Why are we confident that the US economy will continue to do well? What are the factors for which we can project our data? So as I said that when you start, if any of you are using Bloomberg, you open Bloomberg and there's so much data. I mean, there are more data than there are products in a shopping mall, right? When I go to shopping, and most of us are, male, we know shopping में हम लोग क्या करते हैं, we just go to a restaurant, sit in the staircase and try our mobile while our wives are shopping. So I find it very challenging to select. Selecting the data is still more challenging, but there's one data which I think is very important, that in US, the economy is dominated by these services. The service sector is almost 65 to 70% of the economy. So the consumer spending plays a very major role in which way the economy will probably move. And then you can see that orange line, which is the consumer sentiment. After May, June 2023, when there is very clear indication that Fed will continue to hike rates, the consumer confidence has just shot up, right? Consumer confidence has just shot up. In the last 2 months, we have seen a marginal decline in the consumer confidence. So that orange line is sliding. But you see, before that, the consumer confidence for the first half of the year was coming down, and then it has gone up and it has remained there, right? What is also important is that the sentiments also remain strong, and this is the line, blue line, which says the wage growth, right? The increment salary or the incremental income that people are generally getting. So this is aligned to the right hand side. So the wage growth is still in the region of about 5.5 to 6%. And what is the inflation now in US? It has fallen from 9% to 3.5, 4%, right? So the wage growth is still higher than the inflation, which means the working class is still not as upset with the inflation, or their ability to spend is not so handicapped because of the inflation. And I was in US for 2 months, earlier. So all of June and July, I was in US. So I saw firsthand how people are spending or not spending. And generally, I think people there feel a little aggrieved by the fact that the inflation is very high. Especially the food prices are really high, and a large part of the US population is still not so rich. I mean, so people are feeling the bite because of the increase in the food prices. But then people are not exactly so stressed that their spending will not increase. So this all is happening at the beginning of October, when we have the festive season starting globally. So we will have our Navratra, Diwali, that they will have Christmas and all that. So the consumer will continue to spend. Even poor people spend more than usual during the festive time. So I think, therefore, we can also conclude by this that the economy in the US is in the normal course, expected to remain strong. And therefore, we discussed that Fed has 3 objectives. Maintaining growth is one of them. The conclusion from this can be that the Fed does not need to take any emergency steps in terms of cutting rates to address the growth issue, right? And therefore, we don't have to worry about a sudden cut by the Fed in the interest rates because the growth has collapsed. Now, this is obviously a projection in the normal case. If tomorrow some event happens or some new development happens, then the Fed will have to react. So let's say if Israel war, Iran war, anything can happen. So that can lead to change in decision. But as of now, this is the normal projection. Now look at unemployment. What is the situation? So before we discuss this chart, I just want to give you a very interesting data point. In 2013, when there was taper tantrum, right? Taper tantrum, that was when India became Fragile 5 and all that. So that time the Fed said that the full employment is when the unemployment rate is 6%. A 6% unemployment rate is considered full employment because 6% लोग तो कुछ न कुछ कारण से काम नहीं करे. 6% लोग तो ऐसे जिनको काम करना ही नहीं है, right? So that is full employment. Today the unemployment rate is at 3.8%. Nothing has changed in the last 10 years to say that, look, unemployment threshold has suddenly changed. So at 3.5% unemployment, which is historic low, Fed has absolutely no reason to suddenly get worried that employment needs to rate cut or kuch, right? So again, 2 out of the 3 Fed objectives are cut. They don't need to take any emergency action because of growth concern. They don't have to take any emergency measures to address the employment issue. Now you look at the unemployment rate, which has gone up from 3.5 to 3.8 in the last month. But then you see the participation rate. The participation rate has also increased. So that means the net level of employment in the economy has increased, but the unemployment rate has gone up from 3.5 to 3.8 because there are more people who have joined the labor force. So in those countries, the mechanism is a little different. So a lot of people were not applying for a job because the unemployment benefit given by the government was more than the salary they could get. Now that we saw the previous thing, 6% wage growth rate. So now the market is becoming tighter. They are getting better salaries than the unemployment benefit. Therefore, they are beginning to. Also, a lot of people don't want to take up a job unless it is their standard. So if I become unemployed for some reason tomorrow, I'll not maybe take up an Uber driver job or a waiter job. So I will wait for the job of my matching my profile and qualification. So the other thing is those kind of jobs are opening up, and therefore people are beginning to apply. And therefore, at this point, my conclusion would be Fed doesn't need to do anything to address that issue. Look, I just want to reflect back on the last half an hour that we have been having this discussion. And I think if you have attended previous sessions on that, you can see that people start with that inflation and growth and data. I don't think that is the way to look at it. If you don't understand what is the purpose, what is the objective of the central bank, what are the things they are trying to interpret, then it's very difficult to predict that market, right? So coming back to this now, therefore, I think on the employment side, Fed doesn't need to do anything. That's the conclusion. Again, if you see the job market, one more statistics, the orange line is the jobless claims, and you can see the jobless claims are continuing to decline still. So jobless claims every week, how many new people file for employment request. And then you look at the job openings, and then you see the job openings have actually gone up. In the last 3 months, it has become stable. But thing is that neither is this line going up, or neither this line is coming down. This line is still downward sloping, this line is upward sloping. Therefore, if we project this here, suppose October, November, December, January, February, when do you think Fed will get worried about employment? Still the trend is this, right? Now let's deal with the third and the final mandate of the Fed. So Fed has to ensure that the inflation is under control. So their target of inflation is 2%. Last year, the inflation is in the US was 9%, and therefore they had to take emergency measures, series of rate hikes, most accelerated pace in the recent history. Now look at what has happened to the inflation. Prior to the COVID, inflation was basically by and large around the target of 2%. Then you see inflation after the COVID by and large. So during the COVID, it went down, but then once the COVID lockdowns, etc., were over, inflation just shot up. So this is the headline inflation, this is the core inflation. And you see, as you progress, the gap between the core inflation and the headline inflation just widened. Now, why do you think this has happened? Anyone? Because I'm the only speaker, I want it to be a little interactive. Can anyone suggest why this gap widened?
Supply. So demand and supply.
Yeah, anyone can tell me something happened around this time, right? When it started, when something happened around this time, February 2022, something happened.
Ukraine.
Yes, absolutely. So what happened because of Russia-Ukraine? Oil price, natural gas, food prices, right? So see, the inflation was beginning to go up, and then suddenly this Russia-Ukraine happens, and boom. And then the core inflation is not moving so much. Why? Because the inflation has three components, right? Yes, sir.
What's the difference between your inflation and the core inflation?
Yeah, I just coming to. So thanks for asking this question. So inflation has three components: price, sorry, agricultural or food component, energy component, and third is the other services, right? So our other services like the medical cost, healthcare, that is housing, education, right? These are the core component of core inflation. And then there are certain items which are very volatile, like we saw the tomato price go to 250 and come down to 10 bucks. And then now people are just throwing tomatoes because they don't mind. So there is a certain amount of inflation component on which the Fed has no control, right? What we technically, I generally don't use technical terms in my presentations because I am myself very intimidated with that. So there is an inelastic demand, there is an elastic demand. So if I have to eat some in the evening, I will eat. And if I like tomatoes, as long as the budget permits, I will take tomatoes. So the demand for food and energy is inelastic. Therefore, the price for those things, especially when driven by geopolitical factors, there is nothing the central banks can do to control that inflation, right? So they generally bifurcate inflation into two parts: headline inflation, which takes into account everything, and then core inflation, which focuses on the elements where the inflation can change the consumer behavior. So let's say if I go for a movie once a week, if the movie prices double, maybe I'll go twice, once in 2 weeks. So where the consumer behavior or the demand of the commodity is influenced by the price, that's generally as a thumb rule part of core inflation. So the headline inflation went up because of the energy and food prices increase. And then as the Russia-Ukraine situation became stable, these prices came down and they continue to come down. So what you see is that the core inflation, which is more influenced by the Fed's policy action, is still very high at around 4.5%. Their target is 2%, therefore inflation is still very high. However, the inflation has come down, and therefore the Fed also in the meantime has hiked the rates from 0.5% to 5.5%, and therefore again on the inflation side, there's just one more thing. There's something called CRB commodity index, right? So you can see from the commodity index chart very clearly that this had gone up and now the commodity prices had come down, right? So commodity prices went up, then they came down. Now they have kind of bottomed out. So if you see double bottom here, and then the commodity prices are likely to move up from here. So if you look at the table here, the energy prices have bounced back in the last 3 months. So from June to September, the Brent crude prices have gone up by 28%. We know all that they had gone up to $95. They have now corrected to $85, but still up about 10% in the last 3 months. Natural gas, right? This is a good example to understand what is happening in inflation. The natural gas prices went to as high as $9 when the Russia-Ukraine conflict happened. Then in the next 1 year, they fell from 9% to $9 to $2. That is the kind of correction that happened in the energy prices. I don't know how many of you track the wheat prices. So in the international markets, the wheat is traded at bushels per dollar. The wheat prices in the international markets in on Chicago Commodity Exchange traded at as high as $1,450 per bushel. That has now corrected to $600 per bushel. So that is what happened after the panic went up, and then actually it was the previous slide. Then the inflation came down because the food and commodity prices came down. However, in the last 3 months, we have seen a strong bottoming out of the commodity prices. So we said natural gas prices fell from $9 to $2. Where is it now? Anyone? Where is the natural gas prices now? I think it's there. Right? That is 45% increase from $2 bottom in the last 3 months, right? So 36% is here, right? So it would have been already at 210 something. So natural gas prices have gone up from $2 to 2.93, 36% in last 3 months alone. What does it tell us? That inflation came down last year, but now it's not likely to come down any further. And then it is now maybe stable or going up. So that is where the Fed has hiked the rates. So inflation has come down, but the inflation is still high compared to their target of 2%. Inflation is at around 4%. So they have no room to cut rates yet. And they have done enough. So inflation is now a little bit under control. They don't need to continue to hike rates. So then going back to the 3 objectives that we started with for Fed, they don't need to take any emergency measure for growth. They don't need to take any emergency measure for employment, and the economic environment on the inflation side does not allow them to cut rates. They are also not likely to continue to hike rates. Therefore, we come back to the higher for the longer scenario, that interest rates will remain here for a period of time. You can also see, this is very interesting, that where is the opportunity to make money in the debt market if you're a trader? It's a very interesting chart. So how to interpret this chart? This is the projection of the Fed by the terminal rate. So they keep hiking rate, and every time they give a projection that today the interest rate is 4%. Where do they say interest rates will be in 1 year time, 2 year time? The green line at the bottom is the projection of the Fed for the terminal rate or interest rate in 2023, right? That was the projection given in March of 2022. 1.5 years back, 1.5 years back, Fed thought that they will be keeping the Fed rate at 3.5% or 3, I think around to 3%, right? In June 2022, right? Yeah. In June 2023, they are projecting a rate of 5.75%. This is how massively Fed has been wrong, right? They have no clue what is happening in the economy. So every time they meet, so we all know, na, so many times we have some friend coming for lunch. जैसे 1 बजे मिलते हैं, आप 1 बजे पहुंच गए, उसको पूछा किधर, बस आ रहा हूँ 5 मिनट पहुंच रहा हूँ, 1:15 उसको फोन किया, नहीं थोड़ा ट्रैफिक मिल गया, जस्ट रीचिंग 5 मिनट जस्ट वेट कर, 1:30 बज गया, 2 बज गया. This is what is happening. Now we easily smile at the previous example, but this is the magnitude with which the Fed has been wrong. At the same time giving us confidence that they know what's happening, right? The moment you start thinking beyond this, that ये क्या बोल रहे हैं, इनको तो समझ ही नहीं है, and then you know where is your arbitrage in making money. That is where you have to operate. The moment you achieve that level on the fixed income, you are guaranteed a lot of money in your life, right? Equity is not the only thing that makes money. Let me just give you 2 examples, because our markets are still evolving, right? Our markets are still evolving. If you look, I don't know how many of you listen to the monetary policy press conference of the Reserve Bank of Governor, etc. But within this closed room, I'll say, he said that we manage the currency, right? When some operator, so they're just trying to control everything, but they don't know what is happening, right? So if you can understand this, then there is a lot of money. So in Wall Street, so if you look at the top guys, Goldman Sachs, Morgan Stanley, JP Morgan, right? BlackRock, they actually have mutual fund. 65 to 70% of their profits come from fixed income, not equity. Trading, I'm saying, right? So there is a lot of money to make. Our markets are still evolving. There's going to be a time when RBI will stop talking about intervening in the market and letting the fundamentals work. Then our composition of the trading profits will also change accordingly. The biggest scam or the crisis of our generation was in 2008, right? And what was the basis of that crisis? What was the root cause? Subprime mortgage, right? That is debt. So I'm saying that globally the bond markets and debt markets are much bigger. So I was on the point that they have been massively wrong. Massive, they just simply have no clue what is going to happen. Therefore, they said we will keep interest rates at 2.5, then they said 4, 5, 5, 5.75. They are still very naive in their assumptions, right? They were still very naive. They are very childish in their projections. Can anyone tell me where is their naivety showing on the chart?
We kept it stable.
That is the projection given. So let me just interpret the chart for you. This line is that for Fed in 2023, the Fed rate would be 3% in 2004, 24 and same. Here now they're saying that in 23, the rate will be around say 5.75. In 24, it will become 4.5, and then in 25, it will again become 3. Right? So where is the simplicity in this chart? Right? They have no clue about future. They had no clue about future. We know 1 year back. There, this is the problem, right? What is this line saying? Huh? It will fall. It will come back to the average, normal, right? So, lot of times it would have happened to us. हम लोग सब देखते हैं. There is a relative who is in ICU. हम सब बाहर खड़े हैं, चिंतित हो गए, क्या होगा सर? किसी और डॉक्टर आता है, डॉक्टर गोज इन कम्स आउट. जैसे क्या हो गया सर? सब ठीक हो जाएगा, डोंट वरी, इट्स ऑल राइट, राइट? सो दैट इज द ओनली थिंग द डॉक्टर कैन से. डॉक्टर हमको थोड़ी बोलेगा कि इधर प्रॉब्लम है, ये वो, तो फिर राइट. सो इन द वर्स्ट ऑफ द क्राइसिस द डॉक्टर विल ऑलवेज टेल यू सब ठीक हो जाएगा, डोंट वरी, थोड़ा मेडिसिन चेंज किया, or something like that. That is what the Fed is doing. They have no idea what is going to happen. They don't know much more than us. But as long as we can catch their bluff, we are good. So that's where we should focus. Now, we have seen that in the last, 3 months especially, the bond yields in US have just shot up. Now, what are the things which are affecting the interest rates in US? Why suddenly, in March, the 10-year yield was at 335 in US. Now it is at 480. It is the highest in 15 years. What has happened? So there are 3 factors, in my view, that is affecting the interest rates in US. The first is the supply challenge, right? So the US government was facing a crisis on the debt ceiling side. Therefore, they were not able to borrow for a period of time when they had hit the debt ceiling, but the spending was continuing. So the treasury used its cash balances. So they had become very thin. Their cash balances were coming next to zero. And therefore, they once the debt ceiling was enhanced, they started borrowing heavily. So you can see the treasury has been borrowing at a very fast rate in the last few months. So that put pressure on the interest rates. The second was that the Fed has, started doing quantitative tightening. So Fed is selling bonds in the market against buying bonds now. So Fed has been doing a quantitative tightening of $95 billion per month, which means the Fed is selling bonds every month. So earlier the Fed was buying bonds from the open market every month. Now they're selling bonds, and therefore that is again putting pressure on the interest rate. And then you see there is a big change that has happened in the global environment. Now, what is that big change? After the Russia-Ukraine war was announced, the US froze the FX reserves of the Russian. Their dollar reserve were frozen. That has shaken the confidence of the international investors. So every country is now saying, we don't want to increase our exposure onto US anymore. If India is now taking up a challenge with Canada, suppose it becomes worse and the US says your reserves are frozen. So every central bank is trying to diversify away from the dollar reserves. And you can see the global central bank FX reserves have fallen since that time. So that is again putting pressure on the US Treasury yield. So the reduced buying from the Fed, or actually the selling of the bonds by Fed, higher borrowing by the Treasury, and the reduced demand from the global central banks is putting additional pressure on the US Treasury over and above the fact that the Fed is hiking rates. And that's why in the last few months we have seen the yields go up. Now, what is the US yield right now? It is at 4.8%. It is highest since 2007 global financial crisis, and you see the pace has been here. So in three tranches, 1, 2, 3. So there are three waves, and this wave is amongst the sharpest. So yield curve was inverted. Now the inversion has reduced. So you all recall in March 2023 when the Silicon Valley Bank happened, all of us had assumed that the interest rates will have to be cut by Fed. But then Fed made sure that in 1 month's time we all forgot that the Silicon Valley happened. So what is the net conclusion on the US markets? That the global markets will remain volatile and data dependent. Global growth has been resilient, but we have discussed that inflation has eased, but it remains sticky at higher levels. US labor markets have shown weakness but remain stable. Fed is expected to maintain a cautious approach and remain data dependent, with markets continuing to factor one more rate hike by the FOMC. So all in all, I think that is what the higher for longer scenario as far as the global markets are concerned. India is a country with a large current account deficit. We are the largest or the second largest importer of crude oil, and we are the largest exporter of IT services. Therefore, we are big on the demand and supply side, both on the forex. We have a large current account deficit, which we have to fund by capital flows every year. And therefore, our economy or our interest rates or our monetary policy cannot be out of sync with the global monetary policy. That's why we have spent half an hour trying to understand what is happening in the global markets. Because if you don't understand that, then you just simply can't figure out what RBI will do. Because for us, the global environment is very important. The second is that the Fed is the mother market for interest rates, whether we like it or not. As the saying goes, that if the Fed gets a cold, the rest of the world sneezes. So we cannot ignore what is happening in the global markets. If you don't understand what is happening in the global market, it is very difficult to understand what's happening in the Indian market. Let me quickly turn to what's happening in the Indian market. So as I say, India is at its resilient best that we have ever seen. कुछ भी हो जाए, market नहीं गिरता, right? That is why it is happening. Last year we saw massive selling by the FPIs. पहले हमारा पैसा बनाने का फॉर्मूला क्या था? शाम को FPI के सेलिंग ने हमारा बेच दो, 3-4 दिन एक हफ्ते बाद रिकवरी और क्या बोलते उसको बाइंग बैक लेवल मिलेगा. If FPI is buying, just keep buying. कभी market गिरे. That has changed. Last year FPI sold massively, but our markets were strong. In our generation, in our lifetime, we have not seen a crisis like COVID. We had never imagined that we will be locked into our homes and all the country will be closed, the whole world will be closed. Everyone had a challenge during that time. I think the way our country has come out of COVID is an example for the world. And that's why India is a very strong economy. Russia-Ukraine war, whatever happens, we as the normal citizens of the country have stopped thinking about it. Doesn't even matter. अरे उधर हुआ तो हमको क्या लेना देना, right? So just one simple, day-to-day example you can relate to this, that when COVID happened, first lockdown happened, what was our first thought? ये लॉकडाउन हो गया, चावल कहाँ से मिलेगा, सब्जी कहाँ से मिलेगा, ब्लैक मार्केटिंग होगी. Every time in the past, in my life at least 30 years, We have seen ऐसा होता है तो ब्लैक में पैसा दे के फटाफट अपना, but 1 week into the lockdown, everything was smoothly organized. Then we saw how much, media discussion happened on vaccine. Everyone had his view. At the end of the day, it is one of the most successful ever vaccine program anywhere in the world at this scale. So India is at its resilient best. Why we think that India is at its resilient best? This slide we will take up a little later. Look at the GDP growth. So GDP traction continues. You look at the, GDP again has three components: consumption, capital expenditure, and net exports. I think our exports is our weak, side. Our Indian exports are still very, very uncompetitive, and we are incompetitive on exports, and it is happening at a time when the global economy is going to slow down. So that is one factor. So GDP has three components. Consumption side is, I think, our strength. In India, the consumption pattern is changing. I don't know whether we discussed about it or not. From my perspective, there are two-track consumption patterns in India. There are two tracks. One track is that people who already have money, but whose lifestyle is changing. So all of us again can relate to this. गांव में हमारे रिलेटिव होते हैं, पैसा उनके पास बहुत है लेकिन कुर्ता पजामा पहन के घूमते, very simple lifestyle. Their lifestyle is changing, right? They are all shifting to the same urban lifestyle. They now, पहले वो अल्टो में खुश रहते थे, अभी उनको भी उनका रिक्वायरमेंट क्रेटा से शुरू होता है, right? I don't look at data points so much, but you look at data points of the rural demand. In the four-wheeler segment, the overall number is now highest. But within the four-wheeler segment, the base model, their sales are falling. And the SUV, mid-range SUV is the highest selling car vehicle. So what is that telling you? The demand pattern is changing. जिसके पास पैसा था लेकिन खर्चा नहीं करना था तो वो अब सीख रहे हैं. तो अभी कोई भी शादी होती है तो मोस्ट ऑफ द टाइम व्हेन वी यूज्ड टू हैव अ मैरिज इन द फैमिली, यूज अच्छा उनके घर जाएंगे देखेंगे कैसे. नाउ व्हाट हैपेंस इन अ टिपिकल मैरिज, यू गो टू अ रिसोर्ट एंड कम बैक फ्रॉम देयर. हमने लास्ट आपने 10 शादी अटेंड की, उसमें जिसके यहाँ शादी में गए उसका घर देखा आपने? सही ना, 10 साल पहले देखते थे. So that is the change in the lifestyle. That is boosting consumption big time, is my point. Because of the logistics development, why we are talking so much about logistics sector in the on the equity side, Amazon, Swiggy, some, I know a lot of relatives who now wear branded shirts, who order on Amazon, it is delivered in their tier 2, tier 3 city. So that is the first level, I think. Let me just check. So that is the first level of consumption habits changing. The second is the change in the consumption pattern of the younger generation. पहले हम जब बड़े हुए थे, हमने पहले कमाना शुरू किया, थोड़ा थोड़ा जमा करके पहले एक गाड़ी खरीदी, फिर घर खरीदा. I think most of the people here in my generation, my age band, I think all of our experience is that most of us bought our first house in the age of 42, 45. Am I right, wrong? Right? As an average, I mean, some people are very successful, some people are still struggling to buy house. But I'm just saying, हमारे generation में typically some person will buy first on the age of 40 to 45. Today, the whole environment has changed. The fintech, lending, the housing finance companies, the way the projects are developed. So today, people get the first salary, then first EMI. What I'm saying is the consumption in our life generation. So if I say I'm one generation behind the current generation, in our generation, consumption was followed by the earning. Now it has become parallel. आप इधर कमाओ इधर खर्चा करो, right? And my son has just started working, and I told him to पहला काम करते रहे, जितना सैलरी उससे 4 गुना सैलरी वाला घर ले लो. What I advise other people, because you are not spending money, you are arresting inflation, right? So therefore आपका जब सैलरी 4 गुना होगा, आपका घर का वैल्यू उस समय, EMI should be 1/4. Now what if things go wrong? He says, अच्छा अभी तो जॉब लगा है, कुछ नहीं हुआ, छूट गया, क्या होगा? I said, तू घर ले रहा है ना, you're not spending, sell house or pay EMI for some time. So I think the point I'm trying to make is consumption pattern is changing. The spending is getting affronted. So both these trends are just about starting. Therefore, we can be very confident about the sustained consumption in the Indian economy. क्योंकि हम 4 रिलेटिव को जानते हैं जो उनका लाइफ स्टाइल चेंज हुआ है, बट वी आल्सो नो 40 जिनका भी होना बाकी है, राइट? ओके, सो and then I think on a serious, not serious, I'm always serious, but on a more technical side, I was serious also. The capex, private capex, I think we are getting the first hint of the private capex beginning to take firm steps. So a lot of companies are now hitting the capacity utilization level where they're beginning to plan the capex. I think the political continuity is a very important factor in those decisions. So it is again, I'm not debating about whether this government is good or bad. The point is that this government has been there for 10 years. We know what to expect. All of us in the job sector at least have been very badly affected because the tax rate has gone to 40% from 30%. But still we love this government. I do. But then if in the election बहुत कम ऐसा होता है कि अपने कष्ट, लेकिन still you like the people because if you pay 10% extra tax but if you get 30% more benefit in other areas then it is good. And वो टैक्स तो लगता ही है, चाहे पक्का में लगे कच्चा में, पहले करप्शन में. So but let's not get into that. What I'm saying is that lot of companies may hold back their capex plans because they want to see whether the political continue to happens or not. I am not saying whether the next government will be better than this or the worse than this, but whether that government is better or not better, it will take 2 years to understand. Therefore, I think next year we should expect an explosion in the capex. Therefore, the GDP growth, to my perspective, is going to be maintained. The weak point, as I said, is the exports. You have seen the last month's export number. If not, I will just show you. The exports have collapsed last year, last month alone. The exports have fallen from non-oil exports have fallen from 116 to 105 billion dollars. The imports are stable. तो हम लोग अभी भी बाहर फॉरेन चीज, whenever we go shopping, we don't take anything from here, we only get something. नहीं, हम लोग बाहर जाते हैं तो अपने बच्चों के लिए यहाँ से क्या लेके आते हैं? खाना लेके आते हैं. And then we come back with a lot of shopping. So no, the point is that we are still largely an economy which is dependent on imports for a lot of things, but then we are struggling on the export. So that is one negative thing that can happen to the GDP, but that's not a big factor. The fiscal capex have already discussed that the government is putting a lot of focus on the capex. If you look at this year's budget, the fiscal deficit to the budget as a percentage has marginally come down, but that's also because the nominal GDP has gone up. But this is the first year in my 30 years where the revenue deficit has been stable, marginally come down. The entire increase in the borrowing by the central government is allocation to the capex, right? So that's a very, very healthy sign. However, there is still a challenge. We may not be able to meet fiscal deficit because in the last 3 months, the oil prices have gone up, so the oil subsidy will increase, fertilizer prices, etc. Then this free food and ration scheme continues. So every year government says in the budget that it will not continue, but then they say अच्छा election आ गया तो continue तो करना पड़ेगा. So that I think is a bit of a challenge. But if you look at the tax collections, by and large the tax collection picture is very healthy. So the chart is, this is the April to August 2024 actuals, right? And this is the percentage of the budget that the government has achieved, right? So if you see, by and large, we are in a very good shape, except this one, right? This is the corporate tax, right? surprisingly, because the companies are showing good profit, everyone is happy. But then you will see corporate tax collection is lower than the prediction. Where we have the advantage is in the GST, right? Gross tax. So by and large, we are happy in every sphere. The percentage collection to the budget estimate is on track, right? The 5-month FY24 fiscal deficit was 19% higher than the corresponding period of the last year, which is because the FX, the capex was still there, right? So this is the capex. If you can see here that in the previous years, percentage of capex budget is spent in the first 5 months was lower than in the current year, right? Therefore, the fiscal deficit is already 19% higher than the previous year, but that is because the capex has been very strong. But overall, as I said, there is a bit of a concern that the government may breach the fiscal deficit target, but it's not a big challenge as for me. Again, last slide on the corporate side and the GDP. If you look at the high frequency indicator, what we call high frequency indicators, generally there is a mixed picture. So the urban demand is up 27.7, whereas the rural demand is, as I said, two-wheeler sales. Again, you can see no one wants to buy a bike now anymore, right? People want to start with the four-wheeler. So the three-wheeler sales are up. Most of them are electric vehicles and so on. And therefore, by and large, high frequency indicators tell you that the economy is going on a strong path. The demand is good. On the rural side, there is a little bit of, I think, disappointment, but by and large, it is good. So if you look at last row, that is construction, steel consumption and cement production, you will see again the numbers are very healthy, and therefore I think we can be confident that the economy will continue to do well. Then, therefore, again, RBI does not need to take any emergency measure to cut rates to support growth, right? Then you look at the liquidity. Liquidity in the system has now turned negative, right? So we had a surplus liquidity, and now the liquidity has turned slightly negative. During the COVID time, we had a huge, massive inflow because Jio started with the divestment of the telecom that brought in about $21 billion, and then FDI in the last 2 years has been record at around $85 billion. So there's a lot of money coming into India. This excess liquidity in the system, right? And now those flows have begun to sober down, and there is a lot of FX outflow that is happening. So the forex reserves have fallen from high of 660 billion to now just about $600 billion, and then there's a currency going into the system. If you see the projection, the liquidity continues to be negative. So therefore, again, RBI does not have to do much to control liquidity because excess liquidity leads to inflation, and therefore the liquidity is under control. And this tightness in liquidity, as I was saying, was because of the credit pickup. So we have seen that in the last 1 year, again, you see the credit. So for the entire COVID period and after that, the bank deposits were growing at a faster rate than the bank credit, right? Again, in the last 1 year, we have seen the credit pick up strongly, and the bank fixed deposits have not been growing at the same pace. So that means bank deposits are shrinking, and therefore the liquidity is getting tighter. But this is also a very strong indicator of the growth momentum, right? Because the credit pickup happens only when the business is growing. We have to be careful.
Have you gone into details what credit it is? What credit is it? Is it business industrial credit or retail credit or personal loans credit? Because most of the growth is coming from personal loans, not from industrial credit. Industrial credit, as you said, the capex is awaited post elections. So maybe credit growth is there, but the credit growth is in personal loans and small loan sector.
So credit growth is distributed. This is obviously the total credit growth number. See, credit growth is percentage wise highest in the retail segment, but that retail credit is out of the total, not a big number. So it's like 10 रुपए की चीज 50% गई तो 15 रुपया ही होगा, और जो 90 रुपया का चीज है वो 2% भी गया तो, right? So I think let us not get confused with the percentage and this. Yes, the industrial credit has not picked up. What I said is the capex has not picked up, but the working capital, right? Because everything has gone up. The inventory levels of the corporates have gone up. So the working capital demand has improved, very, very fast. So the industrial credit, the working capital component of that has improved or grown up. Retail is the largest growing segment. It's expected because I talked about the consumption pattern. So you should expect the retail to continue to grow. We have to be careful about the monsoon because there is a mismatch between the monsoon and the. So you can see on the graph, there are 2 red or orange marked areas, 3 actually. These are the 3 granaries of India. So you have the eastern part, which is the rice producing nation segment of the country. Again, Kerala left hand side is largely rice, and then northeast again largely rice. This is the situation as of today. But then if you look at this, there was a large deficit of monsoon in the months of July, August, September. In the last few days, we had a good rain, so average has come down. But the rainfall has been uneven. It has been a late spurt of the monsoon rains, which is why some of the wheat producing areas are also suffering. Therefore, we can continue to expect more volatility and pressure on the food prices. And you can also see from this chart that the wheat prices and the rice prices have been growing up every month in the last 5-6 months, 1%, 2%. And then this is the price of pulses, gram, arhar, urud, everything is going up. So, and you see last month again, pulses prices have gone up. So agricultural or food inflation is still having a positive momentum. The government has taken a lot of measures to address this issue. The government has, as you can see on the screen, number of measures. So you have, sorry, I think, yeah. So government has taken measures to address the inflation issue that has helped somewhat. Then the 10-year GSEC yield has again shot up in the last working day because of the RBI monetary policy announcement of open market sales. The 10-year yield has largely remained range bound, but now it is showing signs of going up. Rupee has also been under pressure, and rupee has gone to 83 levels. It threatens to go closer to the 85 levels. I hope it doesn't, but again, if RBI is intervening too much, then it is showing signs of stability. But the moment RBI can change its view anytime, and therefore that is something we need to be careful about. And then we have seen since the start of the current rate hike cycle that the yield curve has got flatter, right? What does this mean that the yield curve has got flatter? That the 10-year yield had already moved higher in anticipation of the RBI's rate increase. So this is the yield curve as on August 2020. You can see that the difference between the long-term rates and the short-term rates is very high. So this means that in anticipation of the increase in interest rates by Reserve Bank, the long-term rates had gone up. After the Reserve Bank started hiking rates in May 2022, the short-term rates have gone up, and now today this is the yield curve. So yield curve is very flat. Yield curve is flat means the difference between 1-year rate and 5-year rate and 10-year rate is not very high today. Now in US, the yield curve is inverted. The long-term rate 10-year yield is lower than the short-term rates. Why? Because markets are pricing in a rate cut by the Fed in some time. In India also, people are saying by this flat yield curve that maybe RBI is not going to hike rates any further. Now there is very interesting development that we have seen in the current cycle. As I was saying that India is at its resilient best, and now we are seeing the divergence between how the US monetary policy is happening and how some of the emerging market central banks are positioning themselves. So effectively, they are saying that in US, it is your problem. Your inflation is your problem. It's not my problem. Especially after the 2008 global financial market crisis, most of the emerging market central banks have taken significant steps to address the challenges that they faced that time. So today, most of the Southeast Asian economies, Malaysia, Thailand, uh, Taiwan, not Taiwan, but exactly Vietnam, they are all having very high forex reserves. India also has very good forex reserves. Most of these countries have very moderate inflation because in the COVID time, the Western governments had thrown money to the public, which had led to inflation. But in our country, the governments were very restrained. We did not use our financial power at that time, but after the COVID problem was over. And therefore, today, our economy is far, far stable. Our macro fundamentals are far stronger than those countries. India has no growth challenge. US has a growth challenge. We are used to 5% inflation. That is our historic inflation. US is used to 2% inflation. Their inflation is 4.5% after so much rate hike. So there is a challenge. So at some point, like when the kids grow up, they challenge us. So now India is telling, look, your problem is your problem. Why should we suffer? So it's not only the India, but the whole bloc. If you see, Vietnam has actually cut interest rates in the last 1 year. Mexico, Brazil have cut rates in the last 1 year. Mexican peso is the is one of the currency which has actually appreciated against the dollar in the last 1 year. So there are significant structural changes in the global power balance that is happening. It's not happening only on the political side. We are seeing it happen also in the market side. As I was telling you earlier, that in the face of one of the strongest selling by the FPIs on the equity side last year, we saw money, the markets remaining so stable. Same thing is happening on the bond market side also. And this is the action taken by the different central banks during the last 1 year. But what has happened because of the preemptive aggressive stance taken by the Reserve Bank, that the difference between the US yield and India yield has come down. So at the time of the COVID, the difference between Indian 10-year yield and the US 10-year yield was almost 500 basis points plus 5% or more. That difference has now come to 2.5%. So जब कोविड शुरू हुआ तो difference between our yield and their yield was 5%. That has fallen to 2.5%. Is it the job half done or we are going back? We have to see. So this is the result of the ability of the Reserve Bank to manage affairs better. So I can give you a lot more examples how the correlation between the dollar index and the Indian rupee has completely got shattered, right? So just to give you in a way that you can visualize, when dollar index was 100, rupee was 72. When dollar index was 115, it was still 74. Then dollar index came back to 100, rupee went to 83. So what we are saying is that our correlation with the West is not 1-to-1 anymore. We have our own power equation, and therefore we do not panic now when the US has a problem. But at the macro level, because we have still a huge connection with the global economy, and therefore our macro fundamentals have to be in sync with the rest of the global fundamentals, but it does not have to be a 1-to-1 equation anymore. So it's like if in the past US has a problem, India has a problem. Now US has a problem, later or sooner India will have a problem, but it will be managed in a way that it does not cause pain or disruption in our markets. And therefore, it's like if I have decent savings, then if I have a problem, then I can deal with it better and then I can gradually recover. So I think that's a very strong thing. So what is the outlook? I think we have discussed most of it. Market is reconciling to higher for longer. The domestic economy is strong. The crude prices need to be watched carefully. Inflation has again stopped going up, but it has not come down enough for RBI to be able to cut rates. Now, very interesting slide. This is my last slide for the day. And after this, you can. So now what is happening that in the last 3 months, we have seen the markets realign themselves. In March, when the Silicon Valley happened, we had all assumed that the Fed will have to cut rates because the markets are going haywire and a lot of GFC type of problems are happening again. From there to today, so March to September, the belief of the market or the market positioning has changed from an early pivot to higher for longer. Therefore, the markets are repricing themselves. Now, there are things which are very fluid in nature. So things have begun to get a little worse, but it is not sure whether the things are changing at the structural level. So RBI is acting like a pendulum. So RBI has a central scenario. So if RBI is right now at pause, they are working with the scenario of moderate growth, inflation within acceptable band, and global stability. If this is the best case scenario, if things get worse and market becomes very bearish, then they will take action to bring the market back to the normal. And if market becomes too optimistic, then they will take steps to again bring the market to a fair level. So right now, I think RBI is still in the process of taking a view whether the changes in the markets are structural in nature and therefore they need to hike rates further, or these are temporary disruptions and therefore they can manage it, through tactical measures like liquidity adjustment, and then let the markets come back to the fair level. I personally think that the 10-year yield can go to 7.5 to 7.6% level, but India's fundamentals are very strong. So when it goes to 7.5 to 7.6% level, it is a very good time to invest. Thank you so much. I'm happy to take a few questions if you have any. Thank you.
Thank you.
सर जैसे आपको बताया कि वेल्थ अगर एक बार बन जाए उसके बाद हमें हमारे पेरेंट्स को बताना चाहिए कि शुड इन्वेस्ट इन दैट मार्केट सो व्हाट आर द प्रोडक्ट्स which we can suggest to our clients like there are few products जैसे modern day product marketing ventures वगैरह भी काफी ज्यादा ग्रो होते जा रहे हैं तो मार्केटिंग वेंचर्स वगैरह भी जो न्यू एज प्रोडक्ट बोल रहा है जो तो हमें ऐसे कौन सा प्रोडक्ट है जो हम हमारे क्लाइंट्स को बता सकते हैं फॉर इन्वेस्टिंग इन मार्केट्स.
So I think there is a range of products. I think I can only talk about mutual funds because I personally think mutual funds are the best. I think this there is connected. So there is slide on the mutual funds. So there is mutual fund for sure, and mutual funds need to be direct. So when you are trying to preserve your wealth, there are different objectives. So risk you are taking ability. MLT is a very risky instrument according to me. So we have seen historically every time periodically there are problems. So you have to be careful. I think that is the subject by itself which we can spend 1 hour. So I think I can't give a very short answer, but by and large, if you want higher return, you have to take higher risk. So you have to see where is your balance between taking risk and reward. From my perspective, when you are investing in debt market, there is only one risk. That if the person to whom you give money, he doesn't return to you, all your return खराब हो जाएगी. तो इसके लिए आप इसको पैसा दे रहे हो, that is very important because उसने टाइम पे आपका पैसा रिटर्न ही नहीं किया आपका, right? So I think just cutting it short, from a practical perspective, I will avoid low rating वाले instrument. I will avoid high return वाला product. I will invest there only if my risk permits me. Otherwise, from my perspective, there are two realistically good products. One is the bank fixed deposits, the other is the mutual fund.
So just carrying forward the question, Franklin Templeton and MTech auto issue हुआ था, debt mutual fund का. So I think so that was a triple A rated one. So why that issue happened and possibly what steps have been taken further by the system to avoid such fiascos in the future?
See, first of all, I don't talk about other mutual funds. I'm here to talk about debt market. But see, those things happen, right? You have to say that suppose industry का AUM 100% है, उसमें से 0.5%, 1% AUM पे problem हो, that cannot be generalized. And today, I think the mutual funds are the fastest growing segment in the economy. If you think about it, 2014, the total AUM of the industry was 8 lakh crores. Today it is 48 lakh crores. 6 times in 2000 since 2014. Why I'm taking 2014 as a reference? मोदी जी ने खुद बोला अपने स्पीच में that मेरे देश का लोग इन्वेस्ट कर रहे हैं, not 8 to 48 lakh crores. 6 times since 2014. Actually, this is the fastest growing industry. So I don't think anybody is worried about one or those of 2 episodes, right? Those are even every day flying. एक plane accident होता है, ट्रेन एक्सीडेंट, हम लोग प्लेन में जाना थोड़ी बंद करें, but we stop flying the airline which we don't have trust. So you see, today if you have to go to Delhi, you will get Indigo tickets at, or rather you will get SpiceJet tickets at half the price of Indigo, but you will still not take SpiceJet. So trust is the most important thing. I think by and large people still trust mutual fund industry, but investors have learned their lessons, and which is what I was just saying earlier, that आप हायर इंटरेस्ट हायर रिस्क लेके कितना पैसा भी कमा लो, 6 महीने में सब उड़ जाता है, बिकॉज आपका पैसा ही वापस नहीं आया तो रिटर्न कैलकुलेशन, राइट? So there is a lot of wisdom in some of these things which I generally try to say now right away, but you have pointed out to one example that 10 साल का 1 मिनट में साफ हो गया. You have to be very careful. The most important thing is only lend money to people where you have the confidence that money will come back.
Thank you, sir.
Thank you.
सर आज से 5 साल बाद USD INR का जो रेट है 50 वो आप कहाँ देखते हो? तो क्या बेस मेरे साइड
भैया वैसा देख पाते हो तो इधर आके लेके थोड़ी धन
from beyond all it
मार्केट में prediction
from beyond all it whatever things are
sorry
एक तो assumption लगाना पर आपके हिसाब से क्या होगा?
and see, so I think it's very difficult to predict because I can't tell you what will happen tomorrow in the market. Markets are very unpredictable. But if India's growth trajectory and India's fundamentals continue to improve like the way they have been in the past, I think rupee will appreciate at an average rate of 2 to 5% in a year. So if you let's say 2.5% का annual depreciation पकड़ते हो, so 2.5 into 5 years is about 15 to 20%, which means about somewhere in the 95 type of level in 5 years.
Okay, thanks. Yes.
Do you predict currently the person should invest in a long time or short term?
No, I will suggest that you should invest in long term. There is a very beautiful product in our industry which we call the target maturity fund, which is like an FMP. So target maturity fund is a free option to you. So if you invest in a target maturity fund and if everything goes wrong, then you will earn returns like a bank fixed deposit. So when you invest in a bank fixed deposit, you know that 5 साल में मुझे इतना रेट मिलने वाला है, उतना रेट मिलने वाला है. So if things go wrong, you will earn a return like a bank fixed deposit. But if things work in your favor, your return can be higher. So suppose आपने 7% पे invest किया, 3 साल में interest rate नीचे, you can earn 9% or 10% also. That cannot happen in bank fixed deposit. So what we call in technical terms, it's a free option without any premium, and that has no lock-in. Bank fixed deposit may once you put money for 5 years, you have to remain invested for 5 years. Otherwise, they have a prepayment penalty, which is very steep. In these products, there is no lock-in period, etc. So I think, but why you should invest in the longer term now? Because the income is very flat, which basically market is suggesting that the Reserve Bank is at the close of the rate hike cycle, and therefore the next movement is most likely pause and cut down. So if that happens, you will make money by the longer tenure. So I would say at this point, still there could be some volatility and turbulence, but I would look at long-term investment. I would say 33 to 36 का भी है. So अभी again see in the next 3 months we'll possibly see rates going up. So I will not rush to invest tomorrow, but maybe over a 3 month period, every uptick like equity may be buy on correction here also we will keep on accumulating.
Thanks.
Thank you.
Any other question? Yeah.
Thank you.
Thank you, sir, for the very informative session. To propose a formal vote of thanks on behalf of the entire JB Nagar Study Circle, I would like to propose a vote of thanks to Mahendra Jajoo, sir, for explaining the debt markets in a very lucid and easy to understand manner. You have very well explained all the correlation between the macro factors that influence the debt market. And we express our gratitude for accepting our invitation and sharing all your knowledge that you have gathered in your long and illustrious career. I would also like to thank our coordinators today who have helped us in organizing the meeting and all the members who have come and interacted with the faculties and made it a successful event. Now to proceed for our lucky draw, the last two lucky draws for today, I would request Mahendra ji to take out two lucky draw coupons.
107729.